live in the flesh in the home stadium here today in the One World Trade Center, recording episode 62 of the pod, of course, with Rob Beardsley, CEO of Lone Star Capital, and myself, the Director of Business Development here, with a very fun docket today, good agenda, and these podcasts are always just a skosh better when they're in person, wouldn't you say?
Oh, absolutely. Regardless of who you're doing it with, there's nothing like in person.
Do you want to just also call out, because I know like the inner IT guy in you, the highest paid IT professional in the country, and he was really just oozing about the squeak gear and tech we've got going on. So can you break down some of the gizmos we have at our disposal now?
Sure. We've recently upgraded to the Rode Caster here. This is kind of the best-in-class soundboard. So the mics, all three of them here in this room, poured into this, and thankfully I didn't make a mistake, and we're correctly recording to our drive there, which makes uploading super fast and reliable. I actually take that with me everywhere I go, so when we do podcasts on the go, I can easily set it up and have video and audio uploaded to Dropbox in seconds, so our team can get working on everything. So this is great. I don't know how to work this at all, but our team in Weston should have this thing calibrated so that we sound even better than before. So that's always nice, because I think we kind of I guess we lay off our game and our production quality goes down when we're both traveling.
Well, now that I've got my new little USB jack that I need to buy, but that I have it right now, I'm actually going to buy it probably directly following this episode, but also my roadie mic that you gave me as well in the event if I'm doing podcasts for Fun Friday, most likely. Or even I would say just even our podcast, if I'm on the road and we're apart, I've got that new little contraption to help me have a really great sounding recording. But as our friend Max Ever commented, it sounds like ASMR in the event that we're recording together, because he caught every sip of the water bottle, which is, in fact, it is doing its job. But we got to be very tight and sensitive to maybe muting ourselves if we're taking a sip, if we're drinking, because if you're taking a sip of water, you're probably not talking.
It is interesting. That mic is super sensitive. It's a great travel mic. Sounds really good. But yeah, it's interesting how a high quality mic like this is able to be super high quality, but not take in
too sensitive.
Yeah, too sensitive.
Well, in addition to that, and I got absolutely roasted in the comment section as well when I was typing, because Riverside, I think, is also more sensitive as well. So it might be the addition of Riverside in addition to the new mic that gets it really sensitive. But, if the native source of my recording is the computer, because AirPod audio is not as good as, funny enough, the MacBook audio, every little typing came up, right away.
Yeah, for anyone listening that does ever record podcasts or Zoom calls or anything.
Or if you're going to be a guest on a podcast, which a lot of people that we're, speaking to are guests or kind of in the industry, if you will.
Yeah, if you're coming in as a guest on our show virtually or something, then definitely don't want to use AirPods as your mic, because AirPod mics are terrible. You're actually just better off going right to the native mic on your laptop, assuming you have a Mac or something like that.
But if they don't, let's say you just have a PC, like a Dell of sorts, is that probably better for AirPods?
I couldn't imagine, but we don't have to get into that. They should just honestly email us and we'll send them the Amazon link to get the quick $100 lav mic. It's well worth the cost. Also, for those wondering, we are recording these in our studio in the office on 3 iPhones. So we've got 3 camera angles, all 3 shot on iPhones.
Enough of the tech and the awesome stuff, the investments that we've made into the office, into our production, and for the audience. Let's get into some of the housekeeping items. Number 1, the summit. We've been talking about this, promoting this, and I think we have 2 spaces left. That's it. And I know 2 more people registered today, so it might be nothing. But that is amazing. Dasha and I, and you, of course, have been chipping in there as well, just with kind of the direction of it. But Dasha and I have really done a lot to make sure the event's going to go well. So we're absolutely elated to be really at the home stretch here. It's almost going to be done, and soon enough we'll be promoting next year's event. But no next year event? Is that what you're tipping off here?
Yeah, let's assume that there's not going to be a next year event.
Will there be a event in the future? Will we do a summit moving forward, or is it just going to be an every other year thing? What are we thinking there?
I want to experiment with some different style of events and focus it truly on our investors and not even sell tickets to the public and have an application process to join. I just want to kind of make it even more intimate and more focused on our investors and whatnot.
So really make it more tight-knit, which is kind of funny that goes directly in line with some of the conversations that we've been having recently. Those conversations are kind of get in now conversations, because I think as time goes on, we're going to want to do less and less deals, but only higher quality of deals with repeat partners and customers. So what does that mean? That probably means we're saying no to more people than we're saying yes to, and we're only buying the best of the best deals, which we do believe and know that we're doing so now. But in a couple of years, when let's say maybe you're, a father, you've got some gray hairs, maybe a couple more wrinkles on your, young, delicate skin. I got comments over the weekend saying I didn't look 30, neither here nor there. But nevertheless, when we're a little bit more mature, seasoned, we've seen a market cycle, we've exited, navigated everything, call it 2030 roughly, not much space left. So get in now is kind of the moral of that conversation we're having there.
I think it's such a tough thing. I actually had this shower thought recently thinking about manager risk. So just to recap, the types of risks that an investor can take. And also, when I say that an investor can take these risks, I don't say that they're wrong for taking these risks. You just have to understand that you have to take one or more of these risks in order to earn a return, because you can't get risk-free return unless you invest in treasuries. Everything else bears a risk, and in order to achieve a return, you need to take some risk. So for an investor, there are a few different types of risks you could take. You could take market risk, you could take business plan risk, you could take financing risk, you could take manager risk. So when I say manager risk, there's a risk associated with investing with manager A versus manager B. For example, if you're investing in a sponsor who's doing their first or second or third deal, that is a higher risk than investing with a sponsor who's done 50 deals, right? It doesn't mean that the sponsor that's tenured with 50 deals is going to provide you a better outcome. There's no guarantee, obviously, right? The G word's not in our vernacular.
No, yeah, it's out of the repertoire. We threw it out. Yeah,
it's gone. So there's no
threw
G.
away the key.
However, it's logical to assume that you're taking more manager risk on an emerging manager rather than a tenured manager. So, however, with that being said, though, I think a lot of people actually find value in taking manager risk. For example, shout out to JC Clemens at Flagship Capital. They actually have built their business
on manager risk.
On manager risk, right?
For
they
sure.
are looking for, and if you bump into JC at a conference.
And let's not be too quick to not shout out Brian and Garrett. Great people over there.
True, the whole Flagship team.
Yeah, everyone there is just salt of the earth, just the best people.
They're lights out. So they are specifically seeking sponsors doing their second to, I think, 9th deal, they say.
Mm-hmm.
Right? So they're looking for that sweet spot of emerging manager where they are taking more manager risk, but they feel like through their due diligence process, through the expertise that they bring to bear to the deal, they can actually overcome that manager risk, pick the right people, and in the end do better because their thesis surrounds, okay, we're going to find younger, newer sponsors who are going to work harder to earn my dollars of return, and they're going to be more vested in the success of the deal, and they're going to be able to negotiate more favorable terms for themselves and their capital because they're dealing with an emerging sponsor rather than a tenured
Who's probably
sponsor.
never done a JV deal or maybe structured it unless perhaps they have kind of other experience as like a spin-off sponsor, if you will, where let's say two companies, let's say two Lone Star employees leave, God forbid, and start their own kind of shop and setup. Maybe they've seen the kind of the process, but this is the first deal that they're spearheading themselves, if you will.
That's a great way to take manager risk, actually, because on the surface, that sponsorship could look brand new, but if you're able to kind of peel back the onion and see, oh, okay, well, they actually had institutional operator experience from this company, that company, and put it together. That definitely makes a lot of sense. And that's exactly what we did, right? Partnering with Flagship was the first JV partner that we ever had, and it taught us a lot. It gave them a great return and a great experience with us, and it was a win-win on all sides. So definitely grateful for that. And to your point that you made earlier about kind of get in while the getting is good, is we have long ways to go, and we're still a very young company and an emerging manager for sure. But as we continue every day to put one foot in front of the other, we're going to get to that tenured sponsor status, to that.
I mean, we're almost at literally 10 years.
Yeah, well,
like we're going to look up and it's going to be 2028. We'll have sold probably the lion's share of the portfolio, and we will have a market cycle behind us, 10 exits behind us, and, a couple billion of assets under management likely, and flip through everything right now.
Yeah, I'll be very proud of that moment, and it will be right around the corner, like you
And
said.
then you will have a decade of real estate experience. I'm almost at a decade of real estate experience, for the record.
Well, I think at that point the infrastructure and the operations and the success of the company will speak for itself more than any one individual, right? Which is actually one of the ways that you take manager risk is when you have a younger company, you're taking Keyman risk. Like when Lone Star was started in 2018, people weren't investing into Lone Star Capital. They were literally investing into Kent and Rob, right? So you're just all investing 100% into the people. And unfortunately, back in 2018, if Kent and I were both hit by a bus at the same exact time, there would be no Lone Star. Lone Star wouldn't exist. But now, if Kent and I got hit by a bus, Lone Star would likely survive and continue to exist. Definitely, if one of us was to leave, then for sure Lone Star would survive.
You don't even talk this way. It's
I know. I'm just saying. But a really prudent investor would have to ask those questions, because a really prudent investor, a very cautious investor, would have to ask the question, like, what happens if the company breaks up?
Well, no, we do get questions from time to time asking, in the event that, there's a founder or, Rob and Kent split and break up, what does it mean for deals moving forward? And to be honest, it actually is interesting that's not asked more. It's a very fair question. Now, if you uncover the dynamic of the relationship, that doesn't seem to be whatsoever remotely close to on the table or whatever occur. But it is funny to think that, it's not even asked more, quite frankly, with, a sponsor that's, I guess, as young as we really are ultimately. And, it's a fair question for really anyone until it's a really big, large, functioning, organization, if you will.
Yeah. So to put a bow on this thought and to complete what you were saying earlier, as we continue to progress and become more of a tenured sponsor, we're going to kind of find our lane and figure out the types of deals that we want to do, the types of partners that we want to be working with, and we will get tighter and tighter with that niche and that ecosystem, because we can afford to, and we can afford to get more selective, so we can afford to say no to perhaps some investors that we don't want to work with and say
Honestly,
yes.
recently it's been a lot more capital partners that I'm just like, of course we'll take money where we can get it in some circumstances, right? If a deal's selling quickly, we can obviously, guess what, change the pricing and terms and whatnot. But theoretically, if there's someone that we don't enjoy working with, really more Dasha and I, as opposed to yourself, we kind of have the discretion right now to say, yeah, we'll probably call down the list. I'll call down the list or look elsewhere before we say yes to someone. We want to try some new people out with blending and, of course, our recurring partners in there. But that's already happening right now. And I think we mentioned this. We spoke, of course, off air regarding the subject, which is like, I'd rather do 200 million or 230 million or 220 or even 180, call it, but with incredible terms for us, of course, a great deal for the investors, a win-win, of course, for the partners, but eliminate maybe that one or two deals, at the size we're playing at, 200 to, call it 180 to 260 or so. That could be the difference of, call it doing 3 or 4 deals as opposed to, 6 or so roughly. I'd rather do 4 or 5 really good quality deals that are just, kind of more of sure things that are easier to raise on, not for selfish purposes, but, just that are more smooth process so we can focus on bigger goals on the long-term horizon and not just be buying to buy, becoming kind of a sweatshop, a deal in, deal out, making money on the acquisitions, but really more so of a, hey, we are only buying what we deem to be the best of the best, where I want to throw all my net worth and, mortgage my future on, if you will, so to speak. Like take a HELOC out on my house. I like it so much kind of setup.
If you watch our company video on the homepage of our website, one of the opening lines that I say is, we don't want to be the biggest company, we want to be the best. And to your point, if we're scrambling to take on every new investor possible and please everyone and partner with everyone, and we're trying to do every deal possible and grow as quickly as possible, then by definition, you're not going to be able to pull off being the biggest and the best. It's just very difficult to do both, especially at the same time. So
also alignment and fit on partners, what they're looking for, what we're looking for. It's funny, the more refined I've gotten in my position role, and the more confident I've become in not only our product, what we do, what we're even able to do from a deal structuring level and the unique natures in which we can play in, it's kind of made me sit back and realize that we actually have more leverage than we think. And if someone is, perhaps demanding or wanting certain things, that's totally their perspective. I don't begrudge anyone for that, and there's a chance maybe we could work together in the future. But if I don't see there to be a true fit, I'm kind of saying, hey, perhaps we're not the right fit really early on. It actually happened the other day with a unique situation, which I told you about when we were kind of laughing at. But, they were like, yeah, you're usually the investors and partners looking for a little alpha. And I was like, that's great, but our deals are alpha to start with. So therefore, we don't really have to undercut what we're doing to, basically attract or raise for your dollars. And that's someone we hopefully probably will work with at some point. We will probably raise from that kind of entity, that group. But it was one of those things where it's like, why are we just going to do everyone the favor here?
Well, you do it, you have to, right? And
Yeah.
so a year ago, 2 years ago, 5 years ago, we would have absolutely said yes to that sort of thing. And I don't think there's any shame in that. And even if we said yes today, I don't think there's any shame. It's just what fits our circumstances, and also situations change, right? Because it's funny that you bring this up in this environment, because this is not a gung-ho environment where everyone is looking to invest all their money and sentiment is very strong. Sentiment is actually quite negative right now. It's actually harder to raise capital right now if you ask people in the industry. So I'm a little bit surprised that you are taking these positions, because I would say most people right now are actually the opposite and feeling kind of desperate for capital. But I think, I'm sure you have examples and ideas as to why we're able to be different and unique in this market, which we obviously strive to be differentiated. But I think one of my points is, if we can kind of stick to our principles in this kind of down market and stick through it, then once the market is riding high, then it only puts us in a better position.
Well, and the reason why I'm being almost stern, stubborn, not agreeable in some respects is because I don't want to set an unrealistic precedent that we can't unwind in the future. And people get trained to what you allow them to get comfortable with and used to. So if I just say yes, yes, yes to everything, well, I'm doing you a disservice, Kent a disservice, everyone at the organization a disservice, because at the end of the day, we don't make money on the buy on a management fee, but it's the back end, alignment of interest that our investors and capital partners get with us, which is the back end fees, how well we buy deals, how well we do in these opportunities. And I'm just that confident in our deals. And quite frankly, as I said, I'd rather buy 1 or 2 deals less to have more of an urgency in the deals when we have deals here coming up. But I don't want to set a standard where people can just walk all over us, if that makes sense.
It definitely does.
Yeah. And also, I want to make sure that everything is kind of pre-done and I've got that dog and that fight in me. So you don't have to do that as well. And you can kind of focus on your entities and your business, on the operations, and oversee it. And ultimately, I think I've made this very clear to you. But I set everything up. I have my take. I give it to you, give you the floor, and then you, of course, get final word. But I just want to get the best setup possible, and everyone wants a good deal, and I still want to give people good deals too, and I think we do a fair job of that, but it has to be equitable and make sense for us. And quite frankly, a deal that I don't think we can mention yet, but we'll be closing here in a couple of weeks, we had more than like $6 million of equity that we had, I think, actually about $10 million in excess that we had to say no to, and that's just from capital partners wanting to bring money to our deals, let alone late in the game, funny enough, JV groups wanting to send us term sheets and whatnot. That's crazy. That's an awesome position to be in. So I think maybe that confidence comes from what I'm seeing, but it's also just the standard and precedent I want to set moving forward, that, we really want to be thoughtful about these, and we don't want to say yes to one thing and have the terms just always change on you. Of course, fund-to-fund terms are always going to change because that's the nature of those, but just general at a holistic partnership level, how I see the firm going and kind of the trajectory at some point.
Yeah. No, it's an exciting time.
So all that's to say, we totally did a massive tangent there, but Summit is right around the corner. You mentioned JC. He, of course, will be there. Will he be on the equity panel, or is he going to be on anything, I guess, there related, or is he speaking for anything or helping us there?
He'll be a shark, and he's also leading a small discussion group.
I was about to say he'd be perfect for that. So, and also, it's JC is one institutional person there. I just went through the list. I think there's about 15 to 16 institutional shops here. So just for those who want to get a little flavor and a feel, there's legitimately billions of dollars of discretionary capital coming here. And then also, boutique, bespoke, like fund-to-fund capital, allocating, fund managers that are also attending. Not to mention the best service and kind of vendor people as well in the business, people that we co-sign, greenlight, and work with. So really, if you can't make it, we're sorry you can't. If you kind of skipped this one and wrote it off, that was probably not the smartest and most prudent decision, because if you're looking to bootstrap your capital endeavor and kind of have some of the flavor that we're doing right now, that was probably a mistake to not come.
Well,
yeah. I guess I'm a salesman after all.
There's always next year until there isn't.
Yeah, exactly. Yeah. What did you say the other day was really funny? The youth is wasted on the young.
That's right.
Exactly. So in that scenario, I wish you made it. We haven't talked about this yet, but we also closed a new acquisition in Dallas, which was a 506C. We've been talking about this on the podcast, but Grand Riviera in Irving, nestled between DFW and Las Colinas. That deal, it's funny. The deal only got better and better and better on us as the closing out process unwound. But just shout out to our partners on that deal. Shout out to Brad, to the IPA team, I believe, that did the deal from the broker side. Juniper Capital, Nate Lowy, of course, structuring the debt there. Thank you so much there, and to the whole team who worked through this process. It's great. Just to name a couple of people that really crushed it: Charles Zhu, Gib Irons, and Barrett Oakley were some of our capital partners, just to name a few. But very grateful for the efforts there all along. But as I mentioned, as the deal went on, our debt got better, and the pro forma was getting absolutely smoked, which is such a fun thing to see. So can you kind of touch base on what I mean by pro forma getting smoked and kind of the deal getting better?
Yeah, so for mostly debt reasons, there was a pretty long delay on the closing timeline. So the elongated closing timeline meant there was a big gap from when we had originally underwritten the deal and set up the pro forma to actually closing the deal. And it was such a long gap that we ended up actually going and rewriting our pro forma because the world had changed enough where debt had moved around. Also, rent growth has continued to be robust in that sub pocket. So we reforecasted our pro forma rents and things like that. So yeah, the deal only looked better over time, which is, of course, the benefit that you get in terms of buying in such a strong quality market like a Dallas-Fort Worth or like a Houston or a Phoenix and things like that. So that is just a real big benefit. And it's of course, we were able to reforecast our rent projections, and also those are just projections, right? So it's not a guarantee that we hit them, but hopefully we do. But the other benefit is all the while that our debt improved and that the market continued to grow, our price didn't change.
Yeah.
Right. We locked in a price that dated back to Q1 or maybe early Q2 of this year.
Q1.
Yeah. Yeah, which is around, depending on what asset class you're talking about, that's around the bottom. So that's good timing.
That's just, we were talking about this, I think, before, but, getting alpha just by buying, just by being in the game, just by timing things correctly. And, it cuts both ways, though. We've been on the other side of that for really, 2023 and 2022 has been on the wrong side of the growth, on the wrong side of debt going, in the other direction. But just to name a couple of things as to why the deal got better, well, what do you mean by that? Maxton West, which was a property, about a half a mile down the street, on organic rent bumps was getting about $100 to $120 more on the one bedrooms. And then keep in mind, our property had 200 larger square feet on average than that, subject property there. So also, the property ourselves, our subject property was also getting rent bumps organically as well. And then you splice on the business plan too and everything else there. It was just very exciting to see that. So it was just very encouraging all in all. And something that just got me just really fired up, quite frankly, that it was going in the right direction, ultimately. So just a big shout out to Grand Riviera. It's very exciting to scale up our operations in a said market. It's no secret that Dallas is one of the most desired, most growth-filled market you could possibly find. So to be in a position to acquire our second deal there, to grow our operations, to get a win the board, to get something done when it's not easy to do, was just really a large pleasure and something that I think we're all really proud of here, and will only help our operations. And working with that broker is a big deal too. IPA is probably the biggest broker in that said submarket there of Dallas, right? So to just kind of pull the deal off, all in all, was just very exciting.
True. Also, speaking of which, it's not an easy time to close a 70s deal. I
actually want to talk about that. Sorry to cut you off, but just this phrase, never speak in absolutes. So don't want to speak in absolutes, don't want to guarantee anything, and don't want to speak in absolutes. I think there's the two principles here, and nuance. So never say never, because if you can make a buck somewhere and you can find the value that other people can't, that's oftentimes when you can get paid. So the nuances of a 70s deal and making it more difficult, and also just having an open mind to things. So with that premise, can you kind of lead into your thoughts and what you're thinking, just to contextualize it a bit more?
Yeah, well, when it comes to nuance about 70s deals, basically, generally speaking, when you're talking about 70s constructed assets or earlier, there are some inferior qualities that you don't see with 80s and newer. And those differentiating factors are aluminum wiring, cast iron, galvanized steel plumbing, flat roofs, chillers, boilers, foundation issues, a lot of just inferior construction. And unfortunately, Grand Riviera was built in the 70s. So it does have some of those bad issues, and it does have deferred maintenance. But fortunately, it has pitched roofs, it has individual HVAC, and those are really powerful things. Also, we don't have to worry about aluminum wiring. We don't really have to worry about the plumbing too much. We're addressing some plumbing issues as we speak. So I think the important thing when it comes to 70s deals in particular is that you go in eyes wide open and that you know what you're buying and that you do your inspections and that you budget accordingly, right? It would scare me to see somebody buy a 70s deal and I take a look at their budget and they don't really have much money set aside for those sorts of big ticket items. So we've got a ton of money set aside for roofs, foundations, plumbing, and painting the exterior. And of course the interior renovations, which is where we're going to make our money. So that's the nuance where a lot of investors right now, because of the negative sentiment and because of the shift in the market cycle, people are speaking in absolutes and people are painting with a broad brush and they're saying, I don't want to buy any 70s deals, right? And that's a fair thing to say. I don't think there's anything wrong with that, but you're accepting the fact that you're going to miss out on some potential opportunities by being so blanketed in your approach, saying no 70s deals, right? Because in our opinion, we feel like we found a good opportunity in Grand Riviera because it is well-priced, 70s deal, good opportunity. And the funny thing is with so many people saying, no, I won't do it, is actually what creates the inherent opportunity because there's less competition for said asset. And with that being said, it makes the property more attractive from a number standpoint. It's less competition to buy, but we still at the end of the day have to raise the money. And that's a really tough thing. So the brokers knew that, IPA knew that. Every other buyer that's thinking about buying that property is thinking the same thing. Gosh, the numbers look good, maybe, but I don't have the confidence that my investors are going to back me on this because that's just not what investors are looking for. So it's a give and take, but we pulled it off. And the brokers were super excited. The seller was super excited. They acknowledged that fact. They said, hey, we know that right now is a very difficult time to close a deal like this. So congrats to you and great work. And it puts us in a position to be very successful because guess what? The market is a cycle and it's only going to be a few years, however long it takes, till we get back to another point in time where investors are competing against each other to buy 70s deals again. It's going to happen again.
Without a doubt. And it's kind of interesting. It reminds me of the lunch I had with our friends at Midlock. Shout out to Brandon and Grace. And they were buying a place in, I think, Cincinnati. And they were acquiring a deal that was also 70s vintage product because they're like, listen, like 70s means different things in different places in different markets. There's no development. So 70s being developed, if, other deals are trading that are maybe from the, 60s and 50s, well, 70s is newer then. So it's all a relative kind of exercise here. So that's why, these are nuanced conversation. Obviously, Texas is a little more building friendly probably than the market they were playing in, of course, but I just think that the nuanced conversation is a lot more intelligent than just blanket statements saying no. Because what if, there's a deal that was basically a fire sale that you're getting for an incredible number? What, you're not going to play in that game? You're not going to get, the returns that you're seeking there? So I just think it's a little bit silly and overplayed to, just say no to everything. And I understand you probably get a lot of deals pitched if you're a capital provider of sorts and you see that and you're just not going to, inherently run to it. But that doesn't mean that you can't make money in that, decision. The next thing I want to think about, which is crazy, I sent you and Brad, of course, Brad Oliver, our director of acquisitions, the yield curve, which is officially uninverted, meaning it is more expensive to borrow 10-year debt than 2-year debt based on the Treasury.
Yep. So classically speaking, the yield curve is referred to as the 2-year U.S. Treasury yield versus the 10-year U.S. Treasury yield. And a normal, healthy, functioning economy, you should see a positively steepening yield curve. It just makes a lot of sense. I've used this example before on the podcast. If you're going to borrow money for a day, it should be cheaper to do that because it's lower risk because their repayment so soon than if you're going to ask someone to borrow money for 10 years, right? If you were to want to borrow money for 10 years from me, I would want a nice interest rate because I'm locking up my capital and taking term risk. I'm taking 10 years of term risk. Whereas if you want to borrow money from me for a week, I'd say, oh, well, it's a week. Just here, I'll give it to you for no interest. Let's not even worry about the paperwork or any interest. Like, let's just
Good
do
friend.
that.
Good
Yeah,
friend.
exactly.
Hopefully I get one of those loans soon.
Yeah. So that's the whole concept of a steepening yield curve. Well, what's really funny is sometimes in economics, you see an inverted yield curve where it's actually cheaper to borrow long term than it is to borrow short term. And that's a phenomenon that indicates there are some weird things happening in the economy. And what it's saying is that people are, it's a complicated thing, but people are effectively worried about a recession. And that's why the yield curve inversion is the number one predictor of recessions. It always works. And when it usually takes around 18 months for the recession to take place from the initial inversion. The initial inversion happened, I believe, in March of 2022. So we're now well past the 18 months. So probably in 6 months from now, they'll probably go back and say that today right now is a recession because we have now inverted or uninverted, like you said, right? So now finally the 2-year is less than the 10-year. And that usually is actually the signal that we are, in fact, in a recession. So the inversion of the yield curve means a recession is coming. Then once it uninverts, that means we are in it right now. So that's kind of the latest.
Will they announce it? Are they going to move the goalposts again on us?
No, they're not. A recession usually is announced a year after it actually starts.
Well, it feels like we've been in one for about a year.
Yeah, it could be. So maybe they will announce it after the election.
Right, of course, naturally, right. Well, it's interesting, and they'll blame it on whoever else is there too, one way or another, right? If Kamala wins, well, it was Joe's fault, or probably Trump's fault. If Trump wins, well, it was Joe's fault. So, placing blame accordingly there, naturally. But if you want actually a really good breakdown of, some economic talks, some macro talks, please refer back to the Fun Friday episode with Jeremy Roll. Jeremy Roll is, brilliant Wharton guy, professional and serial investor at this point. Like, that is his career. He has an investor club of sorts. So please refer back to Fun Friday with Jeremy Roll there if you want a excellent breakdown. That guy is just, a wizard. He's a savant. Whatever adjectives or superlatives you want to give someone, he is that. So educate yourself and have him, come. He was at our event last year, of course. He will not be here this year. He's got a lot of moving parts on his ends, but shout out to our friend Jeremy. I hope you were doing great, and he was gracious enough to give me an hour of time. And I think we both actually left the meeting we had together at Salt Lake City, BEC, pretty fired up and just, with ideas percolating and, kind of some fireworks going off mentally on our end, just about the fun things he was saying and just kind of the juice we got from that conversation.
Yeah, he's a little bit of a bear. Yeah, right? He's always kind of like a glass half empty. He's a very cautious investor.
Him and Teddy would get along philosophically on investing, actually, I think quite well.
Yeah, I could definitely see that. So it's good to get that perspective, right? You don't want to have a bunch of friends who are
yes men always,
Pollyannish and thinks everything's going to the stars and all that. Yeah, so you want to have that balance. You want to have some bears in your inner circle who can kind of reel you in. So that's definitely Jeremy.
Yeah, most definitely. And the other thing I was thinking about is, I know we were talking to Brad about something that we may or may not be cooking up, considering some potentially looming changes and differences coming up. But if someone were to get a deal locked up right now, dare I say you could maybe get 5% debt if you were to do maybe a 5 or 7 year, debt term perhaps. Is that a realistic outcome or possibility?
Yeah, we're headed there. 5-year U.S. Treasury yields about 3.5%. If you're able to get a really tight spread of
that'd be very
150,
tight.
Then you could have an all-in borrowing rate of 5%.
Yeah, which is nuts. I mean, what was that at maybe the highest point with, a decent lender spread and where the Treasury high was? I mean, 7.5.
Pushing 7, yeah.
Yeah, crazy to think about. And obviously it's depending on, of course, the nature and the structuring of your debt, but absolutely wild to see that we are headed towards the 5s. We are likely in the recession right now, so there is perhaps, I don't know if I might say light at the end of the tunnel, but I think we've all kind of been in the business just waiting for stability. And it seems like we're getting stable in the sense that rates aren't, volatile by 20, 30 basis points on a daily basis, going up, going down, running up 75 points in your face when you are locking up deals and contract, and now the deal is materially different. So it looks like we might be out of that phase. But what does that mean? That means if a recession is coming, people are going to get laid off, jobs are going to get lost, collections will get more difficult. So it's not going to get easier in that sense, and dollars are just naturally going to get tighter. But it is an exciting time. So it's a time to be positive.
Yeah, and the good thing about the multifamily industry is it's not recession resistant because there's very few things that truly are, right? Like you just said, our business is absolutely affected by a recession. So investors should definitely understand that they're investing in something there's recession risk. However, with that being said, as far back as the data goes, apartment demand every single quarter is positive. The only one quarter it was negative was Q4 of 2022 when we had a ton of projects coming online and very negative sentiment. So otherwise, we've had only positive quarters of demand. So even though we're building a lot, which is about to stop, like for example, there's only about 7,000 units under construction or that are set to deliver in 2025 in Houston. That's absurd when Houston has a base of about 625,000, 640,000 apartments.
Fourth biggest city in the country. New York, Los Angeles, Chicago, Houston, then Philadelphia, then Phoenix. That is crazy.
And of the 800,000 of people, of population growth across the major cities in the country, a third of it is attributed to Dallas and Houston. That's a pretty insane stat. It's never been a time where two cities are taking all the gains.
We also mentioned recession resistant. Of course, anytime, debt is a vehicle and a major factor and player in a deal, there will be some cyclical changes that happen as debt is not always constant. But with that said, there is... Sorry, I'm just totally lost my train of thought.
Well, let me actually say something funny. I just laugh. Remember, I'm not going to say the firm's name, but we were having some midtown meetings, and so we were meeting with some private equity firms, and they were kind of almost scoffing and laughing at us a little bit, like because we weren't underwriting 6.5% exit cap rates on high quality growth market multifamily. And like you said, the funny thing is all-in borrowing rates are heading towards 5 and below, in my opinion. And I don't think really anyone's talking about 6 caps on exit anymore. So it's just funny how the smart people in the room, so to speak, were throwing up their hands, being very pessimistic.
They took a year off.
They took a year off, and they basically just wanted an easy job. They didn't want to make hard decisions, and they didn't want to have to kind of
go out on a limb,
gutsy, go out on a limb.
What, and potentially get fired and lose a cushy setup and lose your carry potentially and not be around for the next part of the cycle and get the next kind of carry and kind of right off to the sunset? Who would want to do that? But remember my thought here, which is, you mentioned recession resistant in apartments and nothing's truly recession resistant. Well, what is going on right now? Of course, as I mentioned, debt is the instrument. Anytime debt's a factor, that changes. But what is going on right now at a unprecedented, rate? And that is the wealth gap and the wealth divide. People are going to be in apartments a lot longer in our lifetime than there was before. And that's just that is just an objective truth. It is a fact. It is a sad fact. The American dream, as we all kind of knew and grew up upon, is dead. It will look differently. I'm not saying the American dream is dead. There's no prosperity. I'm not, hyperbolic Craig here today. I didn't wake up one day. I didn't wake up on the wrong side of the bed. As a matter of fact, I went to bed at 9 p.m. last night. Woke up at 7:30, got a nice workout in. That's neither here nor there. But, it is an objective fact that people are poorer than ever before. What does that mean? That means they're not buying houses, especially not buying houses when all the inventory that's for sale is really not moving that much in pricing.
It's never been more expensive to buy as compared to rent.
The spread is incredible. So that's why deals like this, mobile homes, housing of sorts, is where you want to be parking your money, just from a hedge of sorts to outpace inflation from investing, but just to get into the game and at least get some kind of skin in the game and some real estate investing work for you is kind of the vehicle that we provide, because as I said, that spread's getting worse and worse. It is not getting better, so get into the game in that regard. But you mentioned something which is supply changing. I actually highlighted an article here from The Real Deal, which is such a perfect transition here, actually. So this is titled, for those who want to go to Real Deal, usually we do a screen share. Since we're in person, can't do that, so maybe Kurt can kind of splice in the graphic there. Kurt, hope you're doing great. But the cover of this is rents expected to rise as multifamily construction slows. So just two little points here that I just kind of copy and pasted out of here. In July, the annual pace of multifamily construction started to decline 22% year over year. According to the U.S. Census Bureau, it was down 41% from April 2022 peak. And then 610,000 units are expected to be delivered this year, according to CoStar, the highest level of completion since 1980. So it's funny, we kind of say these stuff months ago. Now we come back to it, reiterate the point, and then, of course, our friends at The Real Deal. Shout out to The Real Deal if you're listening. We would love to be on a show with you, collaborate more in the future if you want, and they've interviewed you, of course, before. It wasn't salacious enough, perhaps, for them to post, but nevertheless, it's funny. We've been talking about this. It goes perfectly to the points we've just been making. This supply is going to go down, and they're just saying here right now, and to the article, it just says that, hey, rent growths are looking very solid for, as we said, 2026 and beyond. It's funny, isn't it?
There's a lot of apartments delivering right now, but the other side of it, there's not a lot. So it's kind of similar to a recession. It's like you get through this supply glut, and then on the other side, there's going to be rent growth, and everything's going to be great. So, yeah, I think if you're able to have a longer-term outlook, that always de-risks your position, and the long-term fundamentals, kind of like you outlined, remain incredibly strong because our population continues to grow, and unfortunately, people don't have the money, and also tastes are changing. Even people that do have money are choosing to spend it not on buying a home, but instead they're choosing to rent longer. Family formation is delayed into 30s rather than having it in their 20s. So
also a lot of markets in the country for a lot of people. I have a unique setup with my residential acumen, but a lot of people looking around like, wait, why would I buy a house? Why would I own a house? I'll just rent for the simplicity's sake of it, right? A lot of people are looking at that as, wait, it's cost so much more, and obviously you're kind of paying a premium probably the first 3 to 4 years, depending on the interest rate environment you're in. And of course, if you got to lock in a sub 4% rate, well, congratulations. You may have something that won't exist for decades, right? But for a lot of people, renting is just going to be a choice, even if they have the option to purchase. I mean, you live in New York City. Buying is illogical. You might buy for emotional purposes here at some point. You might move at some point. Who knows? But all that's to say, there's a philosophical and alignment difference that our generation has, millennials, Gen Z, so to speak. Gen X, I think, and baby boomers are a little closer and tighter in that regard, and they also got to buy houses when they were, worth pennies per se. But let's just call it millennials and Gen Z. A lot of people don't want to own houses moving forward. It's also kind of funny. You'll appreciate this. Total random side tangent, but it was like China sets. Did your family have a China set or like fine dining or fine dish set?
Mm-hmm.
You will never own fine dining and dish sets like that ever.
I wouldn't. I don't know about that.
I would be surprised. You're a minimalist. I know you.
I'm not interested in that.
I know, but maybe future Mrs. Beardsley could be interested in that. But I'm just saying, stuff like that, more stuff, more things, I don't think is actually what our generation values too much, to be honest. Maybe more watches for some, of course, but that's a very small little, role that you could have in your, closet of sorts. But big China sets, big pieces of furniture and whatnot, I don't think that's how people want to live moving forward.
No, the world's global now, and people really value travel. They value being nomadic and
maybe seeing on Instagram and TikTok.
Right, and maybe that. Yeah, actually, Instagram is a big contributor to that trend because
it's cooler for someone to go to Mykonos than it is to buy.
It's easier to flex your lifestyle and your vacation on Instagram than it is to flex your China set at home or something like that, or the dinner parties that you host at home or something like that. I don't know. Instagram has ruined our society.
Yeah, correct. Was it already set to be doomed regardless, though? I mean, it's not like Instagram was just, if it wasn't going to be Instagram, it was going to be someone else, right?
Of course. It's just the instrument, not the cause.
Yeah, exactly. But kind of a funny tangent, just the differences. But that differences kind of coincides with the philosophy and mindset change of why would I own if I can, rent, and then also the spread that I'm not paying for right now, will go to investing in the stock market, into a 401k, into a retirement plan, perhaps into one of our deals. We know a lot of people that are successful, that are millionaires, that invest with us, that don't own a home. It's interesting. Depending on where you live too. If you're in California, you're making a lot of money. It's funny. You could rent in Menlo Park, for instance, right? Think about this factor. You could rent in Menlo Park for less than what the property taxes on the property would be if you bought it today. That is a insane metric where you're basically hoping for, you're basically paying for your go to the schools, right? But, if you're going to public schools, you're kind of getting that anyways. Just a nuts thing to think about how expensive it is to be in some places with where pricing is now.
Yeah. The question is how much will housing prices correct, if at all?
I don't see them correcting. The data to me, from what I'm seeing, in most markets, it's really not correcting too much.
I think it's the rich are just hoarding the assets.
Not just the rich, it's the BlackRocks, the Blackstones, the KKRs, the XYZ, Goldman Sachs of the world, algorithms buying houses. It's not.
That's true too.
Yeah. It also, of course, there are some,
Which is by proxy the
yeah.
people who have assets.
Correct.
It's the wealth gap that's widening, like
Yeah.
you said, right? It's very difficult. Owning your home used to be one of the best ways that someone could kind of rise into the middle class. They could kind of grab a hold of their first real asset, and then that asset would grow for them, and that could open the door for them to also invest in the stock market and see their wealth grow and stuff. And unfortunately, that option is going away in a real way, and also in mentally, it's going away for people as well. They don't even think it's an option anymore.
Yeah, they're as we have said before in other scenarios, they are taking their ball and going home.
Yes.
Take your ball and go home. That's the thought. Well, on a positive note, management updates. We've had some really, really great changes, some great shifts. Of course, that is your focus. Where you go, your energy flows. And lucky for anyone who's worked with Lone Star, you've spearheaded some great initiatives, some shifts, some I guess reorganization, if you will, on some parts there. So do you kind of want to shed a light on some of the latest and greatest updates, some positive kind of tailwinds we're having here, and just some of the great change that's gone on that you've kind of spearheaded?
Yeah, sure. There's a bunch to mention, but I guess I'll focus on reporting and communication because that's top of mind for me right now. So one of my big goals for the year has been to get our communication with investors and our reporting to be twice as good and take a quarter of the time, because it takes so long for us to produce these reports. And, these processes were built for when we had a 4-property portfolio. And now the problem is we have a 20-property portfolio. So the processes break and you have to rebuild. So for every level of growth, every stage that you get to, you have to kind of break it and rebuild it. And so that's kind of what we've gone through, but in various parts of the business. And when it comes to communication, we've done just that, where we've simplified and streamlined our monthly reports so that way they take less time, while, in my opinion, still providing a lot of valuable information and recognizing the fact that, hey, every single month there aren't necessarily a ton of changes. And then we can kind of put more focus and more effort into leveling up and creating better quarterly reports, so that way on a quarterly basis we are providing everything that our investors need and come to expect from our robust and transparent reporting. So that's a work in progress. We've been rolling out the new monthly reports, working out those kinks. I'm super excited about, in a month or so from now, we'll be rolling out the first iteration of our new revamped quarterly reports. So that's a big project for me. And then coupled with that are not just communications that go out to investors, but also distributions that go out to investors. So we've done monthly distributions for a long time. It's a little bit more work to have to process and account for monthly distributions, whereas kind of the industry standard is quarterly distributions. But we feel like providing monthly distributions is just more of a consistent rhythm. Investors obviously love it. They love getting paid more often, faster, and so on. But monthly distributions aren't, there's different types of monthly distributions, because the way that we've done it before is we would distribute the July distribution at the end of August.
It was funny. I noticed that, and it was kind of interesting. It's like, oh, that's a little bit such a delay, if you will, right? Because you're thinking about just something totally different.
Yeah.
Or just not very sequential, and I guess
right. And then
put a bow on it.
And then if you put those ACH distributions pending in the bank, and then it happens to be like a holiday weekend or something, or they're a little late, and then it processes over a weekend, and it might go into September. So you're paying July distributions all the way in September. So that got to be, again, another broken process that we had to rebuild. And so now we're in the process of rebuilding, and we have still a work in progress like everything, but now we're in a position where it's August has closed, and now we're in September, and it's September 9th today, and we're already putting those August distributions in process, and they'll be delivered hopefully before September 15. So that's kind of our goal now moving forward, is that we will process and potentially even have paid the previous month's distributions by the 15th of the following month, and then we combine that with the communications and getting the financials done, which don't even get me started on financials, but that's another whole process that most investors don't really ever look at the financials. That's just the honest truth about it, and I don't blame them. I mean, most people don't want to comb through a ton of numbers. So, but nevertheless, it's a ton of work for us every single month to put together the financial packages and make sure that all the expenses are accounted for and everything. So, we've moved. One of the new things that we've built on is a much better petty cash solution. So we now have this.
What does that mean, by the way? Because you can't just say petty cash and gloss over that. You have to give a little bit of a contextual breakdown there.
Yeah, good question. So in our business, petty cash is basically, essentially like old school. In the old school terms, your property manager you'd give that manager maybe $500 in cash, and then that would be able to cover incidentals. They'd be able to they go to the store and buy some waters that they could stock in the fridge. It's petty cash. Big expenses, obviously, you run through an invoice process. So like your landscaper comes and does your landscaping. They're going to send corporate accounting an invoice, and then accounting's going to pay that invoice, right? So the manager doesn't have to worry about any cash or card or anything like that. That's an invoice process. But for now we have a corporate credit card for all petty cash needs, and those credit cards are issued to every manager. We have tight controls, and then like kind of AI smart accounting, and we can I have to check every single transaction at the end of the month. I check your transactions, I check the property manager's transactions, the asset manager's transactions, and I have to make sure that they're properly categorized. I have to make sure that they look correct, and I have to ask questions if they're not correct. So
how's my accounting look, by the way?
Very crisp and tight.
Yeah, it's pretty good.
It's good.
Pretty good. Yeah, pretty prompt as well.
Yes. No, I have no complaints. Yeah, so that's nice. So those types of the problem is wherever you push for more control, you're giving up speed. And that's always the balance. Like, it's great to have all these corporate controls and we want to be tight, but what if a manager is sitting there and they have an emergency plumbing issue and the plumber will not take an invoice, they have to take a credit card payment or cash right now? It's like, oh my gosh, what do we do? It's like we have to scramble, we have to make exceptions. So you always want to balance.
Or you can pay half of it up front with the cash there and maybe half later, right?
You just don't know.
You
never know. So it's important to have a good balance of control versus speed and autonomy, especially when you're trying to run a large business with a lot of people and distributed authority. So the reason why I went off on that tangent is because all the transactions in July or August, let's say August because that just closed, all those August transactions across these 30 credit cards that we have, they all have to be correctly categorized and allocated to the right properties, and then so on and so forth, and then they need to be uploaded into our accounting software and then actually put together with the journal entries. So a lot has to happen. That's just one tiny piece. It's just a piece that I'm more involved in, but the accountants are doing a ton of stuff when it comes to putting together the monthly reports every single month to make sure that our financials are done right. And before, it took us 3 weeks. Sometimes we would have delays. It would almost take us a month to get those financials done, which is completely unacceptable. And that's why I fired everybody. Okay. And
we haven't really even talked about that.
Oh, we can talk more about accounting later.
Yeah, well, no, we'll talk about just the transition.
The turnover.
A lot of turnover, yeah. And it's, I think, more appropriate. I think we'll tease that for next episode perhaps or in the future. But the amount of shift that you have placed, which, as I said, we'll talk about that later. So that's a little teaser for everyone.
Yeah, so, bringing in new accounting team has been amazing. Everything's been much smoother. And now our target is to get the financials done by the 10th of the following month. So August financials, tomorrow, September 10th. Like, I need to see those financials. I need to see where those are at because we are already processing the distributions today. And I'm going to have the monthly reports ready by the end of this week. And so I need those financials ready. So it's like boom, boom, boom. Everything in this chain has to be done and right. And guess what? Before you know it, September is going to be closed. And then we have to do the same process over again in October. So that's the process. And it's not so simple to just kind of wave your magic wand and say, well, I want the financials to be done sooner. And I want to be able to send distributions out sooner. And I want to be able to not have this process take 1 million hours and have to hire more people to dilute our profitability or to take our team's eye off the ball from actually making improvements at the property level because they're spending so much time just accounting for what's going on, right? Because when you're focusing on reporting and accounting, you're looking at the past. you're not necessarily impacting the present or hoping to create a better future.
Makes sense. And on the management updates as well and kind of reporting and whatnot, we'll kind of get into the change of reporting and, going obviously making it more robust. But I've noticed that we, of course, and we can talk about this a little better now, really went through a process of evicting a lot of non-paying tenants and, kind of making sure the tenants are there, are higher quality, new procedures, new incentives in place. But by these efforts, now a couple months later, we kind of can see the fruits of our labor, which is good paying dents, but delinquency is like almost non-existent at all of our properties, which is so massive. So if you want to break down what delinquency means and also kind of the focus you put there, because I think occupancy is inherently and admittedly a little bit lower than we would like, but our collections are higher than before, which is a really great inflection point because that means for every tenant that's basically in the property, they're actually paying, doing what they're supposed to do, holding up their end of the bargain.
Yeah. Yeah, there's a lot to talk about there, and I also don't want to say that there's no delinquency at any of our properties. We're definitely...
It's been mitigated, I should say.
Yeah, there's still a work in progress. There's still plenty to do, but it's definitely been a great shift. However, it's a little bit of a short-term pain because to your point, like you said, when you're changing the culture where you're going to be more aggressive with evictions and with making sure that you have great tenants in there or no tenant at all, what's that going to do? It's going to cause a higher vacancy factor. And that's what we've seen in some cases, like you mentioned, where we have seen vacancy tick down, but at the same time as vacancy is going down, the collections are going up. And that's the true metric of success. Collections is really the true metric. And that's why we're not so scared by drops in vacancy if they're self-imposed effectively because we're the ones making that change happen. And I've been preaching to our teams, like, all the way down to our leasing agents, our assistant managers, to the managers, even to the maintenance guys. I want all of them to understand the culture of the company and what we're trying to do. And I tell them, if we can't find a high-quality tenant that's going to be a great neighbor in addition to our community, then let the apartment be vacant.
Well, and the best thing about this is a lot of the people who work at our properties live at the properties. So it's not just that you are looking for that, as you mentioned. Of course, people, show them the incentive, I'll show you the outcome. Of course, they are incentivized to have, higher, higher or less vacancy because less vacancy means that, they can get their bonus. But if that person kind of doesn't pass the sniff test of, does this person seem sketchy? Does this person not seem like a, law-abiding citizen? Well, they could very quickly, find themselves not at the place anymore because the leasing agent or the people on site said, hey, I don't feel comfortable with the person here, or it just doesn't feel right. Then I guess they kind of get the discretion. Then,
or you do more rigorous.
Yeah.
I mean, the reality is it's more so just comes down to your screening practices, and we're toggling what our approvals are, what our conditional approvals are, and what our denials are. And so we can have full control over what credit score results in an approval, a conditional approval, or a denial. What sort of felonies and crimes and misdemeanors?
Yeah.
No, seriously. I mean,
I know. It was a visceral reaction there, but it's just fun to think about. But that's apartment investing.
Yeah, we can set all those parameters, and then that can decide who we want to accept and who we don't. And also to your point about show me the incentives and I'll show you the outcome, we've removed leasing bonuses. So in most multifamily properties, the office team gets a bonus for every lease that they sign, and that incentivizes quantity over quality. And if you're not careful, that could be a death spell for your property, right? And so we don't want to incent. I'm saying, I'm preaching, hey, let the apartment be vacant if we can't find the right tenant, right? Because it's all about long-term value creation, not just let's get a lease to sign today and a move in tomorrow and a bonus. No. So instead, our bonuses are based on collections, month in, month out, not, oh, you move somebody in, you get a bonus. So this new bonus program, and I think we covered it on the podcast before, but maybe in a future episode we could dive into it again because it's still a new bonus program and we might tweak it. We might have more to talk about as it goes on, but it's already shown that, again, show me the incentives, I'll show you the outcome. Well, when you put the bonus for the team around collections and making sure that every resident ends the month with a $0 delinquency balance, that's what they're going to fight towards. And so, like you asked the question, what is delinquency? Delinquency is is a very important topic for apartment owners and investors. And delinquency is basically uncollected rent. So if you live at one of my properties and you owe me $1,000 of rent that was due September 1st and you haven't paid me yet, you're now $1,000 delinquent on your rent. And then if
Is that also synonymous with then bad debt?
Good question. So close, but no, because delinquency means I haven't collected your $1,000 yet. So I'm hoping to still collect it. So you owe me for September 1st. It's now September 9th. A lot of our residents, frankly, love late fees. So they just love to pay their rent late, which is A-okay with us because we charge a 10% late fee. And so the property collects that ancillary income.
That's basically almost like a 10% bump on pro forma if they want to pay late.
Yeah, but I mean, we factor that into our pro forma. We assume a certain percentage of residents are going to be late, and therefore we're going to collect that ancillary income. And frankly, I'd probably rather just have them all pay on time, right? Just make your life simple.
Well, you don't want to sleep, or you want to sleep well at night, so.
Correct.
Yeah.
But anyhow, if you owe for September 1st rent $1,000, it's only the 9th, so there's still a good chance that you pay me, right? So I haven't collected the $1,000 from you yet, and that's why it's delinquency. But let's say October 1st rolls around, and now you owe me $2,000 because you owe me for September 1st and October 1st, and now you're $2,000 delinquent. Well, now I'm going to start to think, is Craig going to pay it all? What's going on? And I need to be working with you. My team needs to be super proactive. We need to work on, hey, payment plan. We need to be putting a notice to vacate, filing an eviction. There needs to be process. There needs to be a dialogue. And eventually, something's going to happen. Either you're going to skip town, and we're going to walk the unit one day, and we're going to see, oh, Craig's gone. The place is vacant. And at that point in time, I'm going to take that $2,000 that you owed me, and I'm going to take it off my delinquency because I'm never going to get that money.
It's good as gone.
It's good as gone, and I'm going to write that money off of my balance sheet, and now it's considered bad debt. I've written it off.
I see. Okay. Delinquency is the precursor to bad debt.
That's correct.
Okay, I see. That makes a lot more sense now.
Yeah. And so delinquency is something that we look at all the time. And it's kind of the inverse of collections, right? But it shows you a little bit of a different picture because it's what we look at is the total delinquency, right? Not just necessarily how much do you owe in the period right now, which is September, but what's the total delinquency associated with your account? Because if someone's pending an eviction and like we have residents who basically don't really care about their credit, and so once they get too far behind on rent, now they owe $4,000. Well, they found themselves in a predicament because there's no way that they're gonna be able to catch themselves up. They've fallen too far behind. They're never gonna be able to catch up with the $4,000. So they're just gonna basically wait till they get evicted or wait right up until the point that we get a writ of possession, and then they're just gonna finally skip town, right? And we'll have residents that sit and say like, you know what, I'm stuck, and so I'm just gonna wait until the eviction, because an eviction could take 30 days, it could take 60 days. And so a resident might just sit there and tell us, hey, I'm just going to not pay.
And they're going to wait and basically a day before they get
out.
kicked out. Yeah. Yeah. How much does that affect their credit score, out of curiosity, and like kind of their, I guess, profile, if you will? Because obviously that dings them if they're paying late and whatnot.
Absolutely. So if it's properly reported out, then that eviction is going to live on their
history.
On their history. And so when we screen, if we screen somebody, I think I think we set it to be a conditional. If they have an eviction within the last 7 years, I think it flags back as a conditional approval, assuming everything else is okay. And then in that case, on a conditional approval, we would charge a double deposit. So we'd take a bigger upfront security deposit to hopefully offset the added risk of their history. But as far as their credit score, I'm not sure how much it affects it or to what extent.
Fair enough. Any other management and kind of monthly reporting updates that you want to mention that you have not yet?
Like I said, there's so many different things to get into, but the thing about operations is most of them are just smaller wins, and it's kind of like them on their own. They don't feel like these
I think moving forward,
big
it'll feel
wins.
I feel like moving forward, it'll feel more granular, but not what you were experiencing over the last 3 months. Like I feel like you had a decade of PM and AM experience in, a 2 to 3 month window that you were just in.
Yeah, it's been a very great learning curve, and that's been the benefit of living down in Houston. Obviously, summer is the best time to move down to Houston and
leave New York, right?
Yeah. So
nothing going on in New York in the summer, anyways, right?
I was perpetually sweating, but That's okay.
And we know how much you love warm weather.
I most certainly am built for the cold, but it is what it is. So yeah, it's been a great experience, and I'm set to go back down in a week or so. So looking forward to continuing the
We'll be hosting
process.
some dinners.
Yeah, we'll be hosting some investor dinners in Houston.
Yeah, I'll be pulling up to see the newest, latest, and greatest, possibly, properties that we're looking to acquire there. Going to a event in the Galleria, so that's exciting. Well, we've gone long enough. I think it's been over an hour, but we've got half the topics on the agenda I wanted to get to, but unfortunately, we won't be get to them today. But we will, of course, next time we are recording. We may have a very special guest coming this week, someone near and dear to yourself, of course. So be on the lookout for a guest in the following weeks. We'll probably do a couple more in-person podcasts. We'll probably at least crank out in the next 10 or so days that we're together 3 episodes at the minimum, I would imagine. So very exciting there. But of course, if you have any questions about working with Lone Star Capital, if you are an LP investor or fund manager, capital allocator looking to learn more and getting in before we close the door, if you will, please let me know. Reach out to myself, Craig at lscre.com, CRAIG at lscre.com, to learn more about our systems, our processes, and what we're going to do next and how working with us would theoretically work. This is probably coming out tomorrow. If you, for some reason, were under a rock and weren't able to take the thousands of call to actions pertaining to our summit event, and you wake up in a panic and you want to reach out to me regarding that link, if there's space left, I think there's only a couple spaces left, let me know. The email's still the same, Craig at lscre.com. Thank you so much for listening, and we'll see you next week.